This webinar will focus on the discussion of charitable trusts, the different types of trusts, and when as a planning opportunity, they are a good vehicle. My name is Ann O'Hara, and I'm attorney and principal of the law office of Ann O'Hara, PC. There are two types of charitable trusts we're going to review today. One is a charitable remainder trust, and then we're also going to discuss what are called CLATs. This is a charitable lead trust. Particularly, we're going to discuss the shark fin CLATs, which has been a plan giving tool that has gotten some notoriety of late. Let's talk about a charitable remainder trust, CRT, you'll hear that term. It allows a donor to donate assets to a charity while retaining an interest in the donated assets. This would be a situation where perhaps a donor may not want to write a check for a gift, or rather, a donor may have an appreciated asset, such as stock, that has built-in capital gain, and the donor would like to transfer it to the CRT, and then in turn the CRT, as we'll discuss, as a tax-exempt entity, can sell that, and then the certain portion of the proceeds from the sale of that stock would then be payable to the donor. Specifically, when we talk about the interest to the donor, it would be, and again, this will be set out in the actual trust document itself, the donor or donor's beneficiary will receive a stream of payments for a specified time, such as a term of years or donor's lifetime. And this way, two benefits. One is the appreciated asset will be sold and thereby avoid capital gains tax or capital gain income to the donor, but then it also has the benefit that the donor retains, again, an interest as set out in the trust agreement. At the expiration of the specified period, then the remaining assets will be transferred to the charitable beneficiary. This is considered what's called a split interest gift because both a charitable and a non-charitable beneficiary receive interest in the property. And so for purposes of the gift tax deduction, then there's a specific set way that under the Internal Revenue Code, these values are determined based on the actuarial standards that are set out in the Internal Revenue Code. The annual payment to the non-charitable beneficiary must be either annuity or unit trust amount, which must be fixed and may not change over time. So when a CRT is established through a trust agreement, that agreement needs to set out either what that annuity amount is, or for the unit trust, it would be a percentage of the assets. Generally, what we will see is a percentage of the assets as determined December 31st of the prior year. There are some variations on that, but as I said, it has to be set out in the initial trust agreement what that annual payment, how that annual payment is to be calculated and paid out. The donor will receive an income tax deduction and gift tax deduction or an estate tax deduction if the CRT is created at the donor's death, based on the present value of the remainder interest ultimately passing to charity. Again, as we've discussed, this is actuarially determined based on the standards set forth in the Internal Revenue Code. A charitable trust can also provide a benefit, again, not only as we discussed for not have the donor avoiding recognizing capital gain income, but also because it can provide a sizable charitable deduction, it can help as far as reducing what the donor may be liable in terms of the net investment income tax, or NIT, of 3.8% in addition to regular income tax. This was created as part of the Affordable Care Act, and the net is subject to individuals with modified adjusted gross income, MAGI, over $250,000 for married couples or over $200,000 for single persons or heads of household. By providing a charitable deduction, thereby that's going to reduce the donor's income, which is subject to net. For that reason, it may be beneficial for a donor to contribute IRAs to a charitable remainder trust. Keep in mind that IRAs are tax-deferred accounts. So we look at that in a couple different contexts. One is if the donor in reviewing the financial, his or her financial plan may say, well, I don't need the additional income, or rather I do not want to get a distribution from my IRA and increase my taxable income. Alternatively, that individual could contribute his or her or an IRA to the CRT, much as we've discussed as far as the sale of the stock. The CRT then would receive it because the CRT is a tax-exempt entity. It will not recognize income on that income tax deferred portion of the IRA. Thereby, that's reducing donors' taxable income in that the donor is not recognizing the income in the tax-deferred IRA, but also the donor is receiving a charitable deduction as well, which would then further reduce their taxable income, and thereby reducing the income that will be subject to that additional 3.8% net. There may be an occasion where you have to terminate a CRT. And why would you do that? Well, you're disappointed in investment returns. Keep in mind, it's a split interest vehicle, meaning I'm the donor, I'm receiving some form of income stream, either annuity or a unit trust interest, and I don't feel that I'm really getting the investment or the return I had anticipated. There's cost of administering a CRT. It is an irrevocable trust. Therefore, in order to maintain and keep your charitable deduction, the Internal Revenue Code sets out specific things that have to be followed. Maybe there's a situation where the donor doesn't need that income stream, that interest. Or alternatively, the donor may say, instead of waiting until my death, or instead of waiting for the expiration of that term of, let's say, 20 years, I would rather have that remainder go to the charity today, thereby that, and say, for example, there's a particular project, there's a capital campaign, so that remainder would then go to charity today as opposed to at a delayed time. So how does this work? How do you terminate a CRT early? And you see the term computation of interest allowed. Well, gosh, what does that mean? Well, what that's saying is, keep in mind that with the CRT, we have a split interest. Keep in mind, donors got this income interest, if you will, and then you have the charity has the remainder interest. When we say we're going to computation of interest, what we're saying is we're going to basically, determine what those values are, and then we're going to have a payout. So how do we determine that? Well, we base that on the actuarial value of the interest of all beneficiaries pursuant to the Internal Revenue Code. And then each beneficiary receives their interest as a lump sum payment. So their interest becomes commuted because they're getting cashed out, if you will. The IRS has issued private letter rulings permitting a charitable remainder trust to terminate early if the parties receive amounts equal to their respective actual values. And again, those actual values have to be determined in accordance to the Internal Revenue Code and company regulations. Because CRTs are split interest gifts, CRTs are treated as private foundations and are subject to additional tax under IRC 507 and IRC 4941. A CRT is tax exempt, but by being qualified as private foundation, there's additional rules to follow. Keep in mind that when we discuss and we say it is a 501c3 charitable organization, what that designation means in terms of the Internal Revenue Code is that that organization is a public charity. It's receiving contributions from the public at large. If a private foundation, to distinguish that, private foundation is a foundation or an entity which is receiving its charitable contributions from one source or a select source. So because of that distinction, the Internal Revenue Code says, well, you must follow additional rules, and if there's any self-dealing with the administration of the private foundation, the code assesses these excise taxes. So one of the issues when we talk about an early termination of a CRT will that trigger an excise tax on self-dealing, since it involves the transfer of trust to a disqualified person. Disqualified person is a defined term under the Internal Revenue Code. Specifically, it is any person who has substantially contributed to the private foundation or foundation manager. A settlor, or sometimes you hear the term grantor of a CRT, is a disqualified person for purposes of the excise tax on self-dealing. To kind of put an illustration, if, for example, as a settlor of a CRT if I were, for example, to try to or receive a principal distribution of the CRT in violation of trust terms, that because of my role as settlor of the CRT and me being a disqualified person, that's going to trigger this additional excise tax. There'll be also additional consequences as well. But an early termination of a CRT will not constitute self-dealing if the proposed allocation method is reasonable and the terminating distributions do not result in a greater allocation of trust assets to the income beneficiary to the detriment of the charitable remainderment. Proceeds received by the income beneficiary of a CRT in consideration of the income beneficiaries giving up their interest in the CRT to the benefit of the charitable remainderment will be treated as amount realized from the sale or exchange of a capital asset under Section 1222. Keeping in mind that if it's determined that the CRT should be terminated early, there has to be appropriate planning, because it cannot be a situation where the settlor of CRT says, you know, gosh, I'll give up my dollar, I'll give up my interest for $1. And even in the best intentions, there are specific procedures that have to be followed, because if they're not followed, then again, that's going to trigger adverse consequences, which would include the excise tax and may result in, some other adverse tax consequences. The charitable lead trust, in many ways, think of it as it's kind of a flip of the charitable remainder trust. Charitable remainder trust, we know, split interest. We have very definite income interest. We have a definite remainder interest as set out in the trust agreement. Well, charitable lead trust is a type of trust which the charity actually is one who's receiving the income interest first. The charity receives the lead, if you will, hence the name. And so then once that term is expired, then the remainder will then go to the non-charitable beneficiaries. So think of it this way. The donor transfers property to an irrevocable trust. Remember, it's an irrevocable that pays the designated charity a stream of payments, the lead interest, as we said, for a specified period of time. Unlike the CRT, the charitable lead trust has the ability, at least under the current law, to tailor and have some ability to modify its terms. There's no required payout percentage, for example. There is not, it can be any term of years, unlike a CRT. The remainder to the donor, reversionary, meaning that the donor will get the money back, or the donor can make the gift to the donees who are chosen by the donor, non-reversionary. So, and it's not tax exempt unlike a CRT. So keep in mind what's happening. Because couple pieces. One is the donor is making this gift. They're giving up an interest, the lead interest, to the charity, but because of the possibility that interest can come back to the donor, again, this is not a tax-exempt entity, which, as we'll discuss later, brings in some income tax consequences as I'm planning to the donor and settlor of income tax recognition. Also be mindful that this needs to be an irrevocable trust. This is an irrevocable gift during the term of the lead interest. The basis, now we're going to get into what is referred to as shark fin class. Shark fin, because think of what a shark fin looks like. A shark fin looks like, we see it as it gradually increases over time. We think of that triangle, if you will. So this is why these types of charitable lead trusts have been coined for this phrase. And also keep in mind, as we're going to go through as far as the legal basis to create this particular structure for these types of trusts, is the intent here is that we're going to have the income, the lead interest to the charity is going to be varied over time. And typically with the shark fin is what we're saying is it's going to gradually increase for the charity. With the end of the charitable lead term, then ultimately the balance would go to the beneficiaries. So to point out what the legal basis is, we look at Rev Proc 2007-45 and Rev Proc 2007-46. And specifically, those procedures state that the governing instrument of a CLAT may provide for an annuity amount that's initially stated as a fixed dollar or fixed percentage amount, but increases during the annuity period, provided that the value of the annuity amount is ascertainable at the time the trust is funded. Clats are not subject to any minimum or maximum payout requirements. Keep in mind, when we go to the charitable remainder trust, it's very clear in the Internal Revenue Code and regulations that that has to be that fixed term. It has to be set out. The annuity interest will be X. The unit trust will be X percentage based on the valuation date of the trust assets. So this is different than the CRT. What the Shark-Flynn is sometimes also referred to a variable clat, or as we said, the Shark-Flynn clat. Keep in mind, what does the Shark-Flynn look like? It gradually increases. So the initial payments are nominal during the lead term, and they're followed by a large balloon payment in final years. Typically, what you're going to see, for example, would be I, as a donor, contribute $1 million to this irrevocable trust. So then with those proceeds, what I will want to do, I, the donor, they will have the CLAP purchase a life insurance policy on my life, purchase a single premium life insurance policy on my life. With the plan being is during the lead term, there will be annuity payments paid out in smaller amounts with a final balloon payment. Again, that's the purpose of the life insurance policy. I, as the settlor of the Charitable Lead Trust, would be the insured. So this is a policy on my life. So upon my death, the balloon payment will be paid from the life insurance death proceeds. And then the balance will then go back to the non-charitable remainder beneficiaries. The other important point when we're dealing with CLAPs and also with the Shark-Flynn structure is that go back to these types of irrevocable trusts are not tax exempt. So what that means is that the trust itself would then, generally speaking, would have to recognize any taxable income within that trust. So in other words, I, as a settlor of the CLAT, have made a donation of $1 million to this trust. As those trust assets increase in value and have income, then the trust has to pay income tax on that income that's recognized. Alternatively, and that's where you will see, particularly in this types of arrangements, that this type of trust will then be structured as we call a grantor trust. So what that means is, while it's an irrevocable trust, the grantor or settlor then recognizes the income that's generated from the trust. There's some benefits to that. Let's go back. I've made my $1 million contribution. From those $1 million, we purchased a single premium life insurance policy on my life. With the balance of those assets, then because it's a grantor trust for income tax purposes, we would then invest it in tax-exempt bonds. In other words, what's happening is we've got the balloon payment that'll be paid through the death benefit of life insurance. Any income tax or any income that is generated from tax will be reported by me as the settlor, but it will also be tax-exempt income. So therefore, that would minimize the tax consequences in this arrangement. And also keep in mind that because of this arrangement, and because we're setting this up and we've determined this, then what will also happen is the settlor and donor will then get a charitable deduction. So this is generally, when we're looking at the Shark-Flynn structure, this is generally the structure that's followed. One of the things with Shark-Flynn's, while there is some flexibility, again, the value of the payment stream must be determinable, so it can't vary from year to year. The payments must be made at least annually. Payments can increase during the term of annuity, as we've said. Remember the Shark-Flynn, and there's no maximum increase in payment amount. So there is some flexibility. Again, that's why in many ways the balloon payment, which is then paid through life insurance, it becomes an attractive feature. One of the other values and one of the other plans, why this is an attractive planning opportunity, by using the shark fin approach, you're maximizing the early growth to allow for more to the heir. So in other words, if we're having a smaller payout to charity, of course, that is allowing those assets to increase. Also, because we have the flexibility, we can essentially zero out the gift. In other words, we make a gift to a class, and therefore, depending on what structure we have, we've essentially, our charitable deduction for income and gift tax purposes will equal essentially what we've contributed. So that's an opportunity. Again, as we've discussed, life insurance investment to pay the balloon payment at the end. IRS ruled that testamentary class, now this would be a class that's created under a decedent's last will, and it would come into being upon the donor's death, can make a variable ascending by 20% per year annuity payments to a class charitable beneficiary over its 10-year term without violating any of the requirements applicable to class. So based on this private letter ruling, the IRS at least has given blessing for this structure. One comment on private letter rulings. Private letter rulings are not precedent per se. Basically, it's the IRS saying that this type of structure was presented to them. They reviewed it in that particular circumstances, and IRS said that that was permissible, that in fact you could have this structure with the variable ascending interest to charity over a specified term. We've discussed the charitable remainder trust. We've discussed the charitable lead trust. Again, those are two types of irrevocable trusts. Both have different values to an overall plan giving plan. But I did also want to bring to your attention that there's also something called a qualified charitable distribution QCD IRA. Because keep in mind that an IRA in many ways is a trust itself. Because with an IRA, what we have done is we have an account which we have contributed, which we may be tax-free because we've made a deduction, or maybe as a rollover account. And that account is tax-deferred. So that tax-deferred income then is growing tax-free. One of the things and one of the requirements and why the IRS has said that we can't have an IRA is that one of the requirements for that status is that at one point you have to, when you reach 70 and a half, that you have to what are called receive required minimum distributions. And so what can happen is that maybe you've gotten to the point you now are required to make distributions from your IRAs, and so you're looking at your overall financial plan and determine that, gosh, I don't really need that additional income. I know I have to take it, but I really don't want to add that additional taxable income. Go back to the net requirement. And probably if you're in that position, you're thinking about that additional 30.8% tax as well. So what are my opportunities for planning? Well, what you can do, and that's what the QCD is saying and allowing, is that instead of me to receive up to $100,000 from my retirement accounts, then what I can do is take that $100,000 and then I can have that paid directly to a charitable organization. And then I receive two things happen. I receive a charitable deduction, but also too, that $100,000 I do not recognize as part of my taxable income. So a QCD must be made on or after the IRA owner has attained age 70 and a half. Remember, that's the triggering date for the required minimum distribution, and have to be paid directly by the IRA trustee to a charitable organization. So very specific requirements, and it cannot, this is not a situation where I receive my required minimum distribution and then turn around and write a check to the charity. Now, granted, that will qualify for a charitable deduction, but understand the structure in that scenario is that I, as the IRA owner and recipient of that required minimum distribution, has to include that as part of my taxable income. Again, in any check I write from those IRA required minimum distributions, I would get a charitable deduction. This has the alternative benefit of if I take that charitable deduction and pay it directly to the charity, then I don't recognize it as taxable income. I get a deduction. Again, this is up to $100,000. So, for example, if your required minimum distribution is $25,000, you could still take advantage of that. Again, subject to you have to be on at the age of 70 and a half, and again, emphasize, paid directly to the charitable organization. So that is our review of charitable trusts. And one of the issues to always remember with these types of trusts is careful planning is very important. Also, too, to evaluate the type of gift. And this is also a good vehicle if, again, for example, you're not necessarily wanting to write a check, or you have perhaps a difficult asset to value, real estate, closely held stock, or appreciated stock with built-in capital gains. These tools may be very helpful to minimize your federal estate and gift tax and income tax consequences.